Welcome to the Standard and Rich podcast, where finance meets fun. Join your hosts Danny Gallo and Jonathan Elkoubi as they navigate the complex world of finance with a touch of humor.
Welcome back to the Standard and Rich podcast. Here are your hosts, Danny Gallo and Jonathan Elkoubi. We're going to start this episode off with the news segment. We have a small news segment. Danny, let's get right into it.
Perfect. So some news came out this week about Tesla with their layoffs. So a few weeks ago, we heard that Tesla was laying off about 10% of their staff. And this week, Bloomberg acknowledged that we're going through their files that it was actually 14% that got of the total staff that got laid off. So they went from about 144,000 employees to down to 120,000 employees. So personally, I think that's good news. They need to start lowering their costs. As Elon said, they doubled some jobs that were actually not needed because of the expanding phase and how fast they were developing. So now they've been cutting down on that. There was also Amazon. They came out with some news this week about their Alexa. So they're going to introduce the generative AI to Alexa, but it's going to come with a cost. They're also going to have a free version of it, but they're thinking about charging $5 to $10 for that service. Their Spotify also came out this week, introducing a new basic streaming plan in the US. So the new plan is going to cost $10.99 per month and includes all the benefits of a premium plan, but without the monthly audiobook listening time. There's been a few acquisitions in the energy space as well this week. And American Express agreed to acquire Talk for $400 million from Squarespace, according to Bloomberg this week. And also, if you've been looking around the stock market today, you've been seeing kind of a rotation out of semiconductors. You could see that in just a few days. NVIDIA lost $500 billion in market cap. They were down 18% in the last few days. But also, you could see some stocks like TSM, Qualcomm, and all that also are having a small breather, correcting a little bit since the past week. Bitcoin also has dropped under 60K USD. And that's all for the stock market news this week.
Hey guys, don't forget to click the links below to sign up on Wealthsimple and Questrade to start investing. You will get a free $25 and $50 sign-up bonus with any deposit amount over $1. And also, don't forget to like and subscribe our podcast.
All right, so I wanted to talk about something different this week. Let's talk about how me and Danny decided to invest into a company and how we come to the conclusion whether to make our investments or not. We both have different strategies and we both break it down in different ways and we both have different time horizons. Let's talk about yours first, Danny. What do you do when you invest in a company? What do you look at?
So obviously I do look at their CAGR, so their compounded annual revenue. Yeah, that's it. So obviously I look at that. I look at it if their EPS is growing. It's not the main thing I look at. It is pretty important, but my main thing is because we're looking really more down the line, right? So what are the verticals for this company? So let's say like Amazon. So I'm very bullish on Amazon. Amazon's my my second biggest holding, but my biggest stock as not an ETF. So I'm very bullish on Amazon just because of all the verticals that they have. So you have the robotics point of it. You have really the pricing power that they have on their Prime membership that gives you access to so many things. You have their AWS, obviously, that's growing at a very fast pace. So they're getting into new things. They're cutting costs. They're introducing robotics to their factories as well. So they're really focusing on, and even health. They're doing a big push into health these days. You could go on Yahoo. There's a few videos showing you how they get involved with that. So it's all interesting things. There's other companies like TSM, which is the same thing. So they get involved. They make chips for so many big companies. They're already booked through 2026. So I see that type of growth in revenue that's going to come. They have pricing power as well. So having pricing power is a big deal as well. And then sometimes it's just short term. So sometimes, let's say right now, I'm in energy because I personally think short term wise, energy consumption will, crude oil will go up because of all the tensions that are happening. But that's my personal thesis. And yeah, it's mostly the verticals and where could this company go and the pricing power that it has. Revenue and all that's all fine. Yes, I want to see everything going towards the positive, but I really want to see a nice, bright future for them as well. So, and that they have pricing power and they could go grab more market share. So that's really more
What's
my
your
investment there.
usual time horizon on an investment?
Look, some are more short term, but most of the times they're all longer term, full 5 to 10 years down, or for the ones that are more convinced, like let's say the Teslas, the Amazons, the CP that they just have like a monopoly. I know it's gonna keep growing because they have pricing power. They're really more long term type of stocks.
Okay. So I'm gonna talk about mine now. So me, I usually look for, like you said before, companies with competitive advantages. Pricing power is a competitive advantage. Like railroad, just having the ability of a high barrier to entry. Like no one else could build another railroad. There's only gonna be like one railroad going from there to there. So that's a competitive advantage. Brand, strong brand. So like you need a competitive advantage in order to have consistent revenues. So you look for that, and you want consistent and growing revenues. That's what I look for, and consistently growing profits. You usually look for like 10 years consistent growth and at a good rate too, because you know the growth is probably going to be lower in the future because you can't repeat the past. It could be better, but it's probably going to be worse, just going off odds. So I look for that. And just giving off an example, like Google, you got competitive advantage. They have Google, their search engine. Even the name itself, I'm going to say, I'm going to Google something. When your business becomes a verb, you know how strong the brand is and their brand equity. And they have such a strong competitive position in their market with YouTube, Google, and their whole like suite, Google Suite. They have Google Cloud. I think like they're indestructible for the next 10 years to come. And it's confident, consistent growing revenues, consistent growing earnings, strong balance sheet. Just kind of look for like low risk stuff and like consistent growers, you know?
Yeah, you're right. Like you said, for the railroads, there's so much regulation surrounding that there's never gonna be another company that's gonna invest the type of capital you need to even start a railroad company. And then how long is it gonna take you to make that money back? I There's a very, 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 very low chance we ever see another railroad company. Now, if one's gonna buy out the other, like CP just did with Kansas City Southern in the past few years, that we'll see. It's always gonna be like the FTC and the SEC that's going to decide if those types of acquisitions could go on. But you're never going to see like a new player come into the field. And yeah, pricing power, market share, all that's like important. There's always somebody that could come get your market share. So being like that nice price point and having that pricing power and having lower costs or lowering your costs is always very important. And just having management that cares and wants the stock to do better as well, right? So you could have incompetent management, like one of the stocks I was in, that they only really care about the dividend. They don't care about the growth of the stock itself. They just want people to stay in just because there's a dividend. It's fine that you're growing your dividend, but if your revenues are dropping and your profit is dropping, your money is better served elsewhere. You could keep growing it, but at a lower pace. So that's my 2 thoughts on it.
Yeah, I think we have overlapping ideas. Our investment strategies overlap, but we also have some differences on how we look at it. Like your oil plays.
Yeah, exactly. You're less of those like cyclical type of companies. I don't mind dipping my toes into them, and you're more of a spreadsheet type of guy. Yeah, but not really nice. Catalyst, I would say, forward projecting, or if it's really grow or cut costs, grow revenue, grow margins as well. I'll look a little bit into that and see where they can go in the future. Yeah, I'll look at their spreadsheet, their numbers as well. But I pay a little bit less attention to that, more into what the future could hold for them.
Yeah, I mostly pay attention to the income statement, balance sheet, cash flow statement, and then I run like a fucking DCF.
A DCF, yeah. Yeah, like, look, your strategies have worked for you. My strategies have worked for me so far as well. I would think the only thing I would say is like, I like dipping my toe into a stock first before like going into it a lot, but that's backfired on me a lot as well. I have a few stocks that just exploded after really like starting to dip my toes into it instead of like just really having a firm position. Just because I was like, oh, just in case, like it could just dollar cost average down. Yeah, I'm trying to do that a little bit less.
I used to dip my toes and then wait for it to drop and hope it drops so I can get a better cost basis. But I mean, if you like the stock and you like the price, I've adjusted my strategy. Now I just load up heavily as much as I can. Like when I saw Tesla at 140, I'm not going to buy it and wait for it to drop. I put as much as I could. I sold other positions to put in it. And I basically like loaded up one shot, one day. Everything in there.
That was a very smart move. I did the same with TSM last week, so I decided to liquidate one of my positions and put TSM as one of my highest positions. Actually, probably gonna load up on it a little bit more.
And like a mistake I made, I bought like Facebook at 160, but I made it a small allocation in my portfolio, so I made 200% on the investment, but it was a small allocation in my portfolio, so it wasn't a big gainer.
Yeah, and I remember you telling me that, oh, it's so undervalued. But you never know when that like when the tide's like gonna change and go back. Like you knew it that it was gonna. Yeah, exactly. You need a catalyst that's gonna really turn the page around or like really choose the direction for the stock. Yeah, and like Meta was really about the Reality Labs. Once they saw that they cut their spending into Reality Labs and decided to spend money elsewhere, that's when it really turned around.
Like, for example, Google is an example where I dipped my toes. I think I bought like a small percentage at the beginning, and then I doubled down when it dropped more. So then I got a better cost basis. I think my cost basis was like $95, and now it's $180 a share. So yeah,
Yeah, that's it. So yeah, you did great for that.
that's one
But that's
example of
true. I think, and I think it was proven too over time that a lump sum against dollar cost averaging, a lump sum beats dollar cost averaging.
does it?
Yeah, on a longer term scale. Yeah,
I mean, that only works if you time in the right spot, right? Like if you do a lump sum at the top of the market in 2008 and 2007, right before the big crash, it's not going to work well. But if you do a lump sum in 2008 at the bottom, it's going to work way better, right?
yeah. But if you let's say you bought um this year, next year when it was high, then the year after when it was low, then the year after it was the high, and then it was high, and then it was high, and then it was high. At the end of the day, if you do 20 years, that lump sum you did once compared to the 20 years of just investing it, the return's going to be higher on that lump sum.
For sure. Yeah.
I think they were calculating it percentage-wise, so
Yeah, that makes sense.
yeah.
Anyways, I think that's enough for this segment. I mean, we talked about all we needed to talk about. We got our investment strategies out there. Now you guys know how we invest. And you could copy us. It's not financial advice, by the way. Let's move on to the stock pick segment. Stock battle.
Perfect. So we'll recap the last few weeks. So we have one that's almost at term. It'll be done next week. So we have Baba against PDD. Baba's down 4.76% and PDD's down 3.13%. Remember, guys, do not touch Chinese stocks. Except for that, last 2 weeks ago, we were talking about McDonald's and VersaBank. So McDonald's is up 2.69%, and VersaBank for Jonathan's up 3.58%. And last week's picks were TSMC against TD. So I had TSMC, that's down 2.72%, and TD's up 1.82%. So I got some catching up to do here. So Jonathan, because you're taking the lead on that one from last week, I'll let you start with your stock of the week.
So, my stock of the week, I'm going to pick, I think, TransDigm Corporation. It's a fast-growing stock. It's been up this week. They supply all sorts of parts, military parts, aviation parts, all even to regular airlines. They support all type of parts. They're basically like a parts manufacturer. And the reason this company is so impressive is not because of the company itself. It's because of the management team. The management team has such a great track record, and they've done such a great job that they were... Well, basically, I was reading this book about management, and it's called Outsiders. And they were talking about the greatest managers of all time. And they were saying whatever, Warren Buffett, great CEO. They were talking about other guys who had great business returns in the stock market and great company performance. And then they mentioned this company, and I took a look at it, and that's how I discovered it. And the growth has been phenomenal in the past 5 years. Consistent earning growth, consistent revenue growth, exactly what I look for. And they have a pricing advantage in their industry. They continue creeping up, taking more market share overall, growing over time. I just think it's a great pick for long term, and hopefully it beats you in the week because of the tensions in the war, and they are military related. So let's hope that is enough to beat you for the month.
So that's a great pick. I'll be going with the Formula One group, so ticker FWONK. So it actually has a great moat because of its prestigious motorsport brand. So they hold all the exclusive commercial rights to Formula One racing, which includes broadcasting, sponsorship, and promotion. These long-term contracts provide consistent revenue streams and significant bargaining power. So every time they'll go renegotiate, normally it's always negotiating up. And the same thing for the other big sports brands like NBA or NFL. There are always bigger and bigger contracts. So they really have a big brand strength. So their loyalty really the loyalty of their brands really translates into stable viewership and attendance, which boosts advertising and sponsorship deals. So people, let's say we just had one Formula in Montreal, so we'll have people from Italy come all the way to Montreal because they support Ferrari. So same thing for the other brands as well. And they also have a big moat, so they're the only one that have Formula One, obviously, and it's very complex to start and organize a global motorsports series, which helps Formula One maintain its dominant position in the market. They also benefit from continuous innovations partnerships with the automotive and technology sectors, which raises the appeal of the sport. And well, their parent company, Liberty Media, they keep expanding their portfolio with some acquisitions, just like Dorna Sports, the owner of the MotoGP rights. So MotoGP is the motorcycle races. So they really have a moat in that type of sport, and I think that's just gonna, like I said, it's just stable revenue that's coming in, and it's just gonna further grow. They just had the Vegas event this year as well, so they're gonna have new locations. It's gonna bring in more revenue to the sport as well. So Formula One Group F1 is my pick of the week.
Yeah, I think they're gonna do really well because I know they had their Netflix show. I don't know if you saw that, but it did really well for them. It boosted their popularity. Did you watch that?
No, I haven't watched it yet, but it's been on my list of things to watch.
Yeah, so apparently it boosted their popularity a lot. Now they're growing a lot. Just like all the other sports league, as you mentioned, there's like NBA, NFL, they're all growing really fast, and I think it's just another one of those sports leagues that is growing market share. Netflix show obviously helped a lot, so now they're opening new tracks all around the world. I don't know where exactly, but they have a new one, in Vegas, and they have a couple of new ones around, but they add a couple, like 2 or 3 every year, and
yeah, exactly. I've heard they wanted to go to Toronto, so hopefully they don't take it away from Montreal, but that's one thing that's been going around.
Yeah, so
yeah, thank you very much. Did you have anything to add before we stop the show?
I think we just need to get more people to like and subscribe and leave a comment. Let us know what your thoughts are. If you have any stock picks in the bottom you want us to check us out, comment it below. We'll check it out and we'll mention it in the next video. So I think that's it for this episode, and we are out.
Before we go, a quick reminder. While we love discussing financial topics, we are not financial advisors. The information provided in this podcast is for educational and entertainment purposes only. Please consult with a qualified professional before making any financial decisions. Thanks for listening, and see you next time.